Welcome to Fundamental Deep Dive. I'm Alex, and I'm ready to dissect a mountain of source material today.
I'm Ivy, here to help connect those critical operational dots and analyze what the performance metrics of a major energy producer really mean for the broader market and for you, the learner.
Today we are undertaking a meticulous deep dive into one of North America's largest integrated energy companies, Cenovus Energy Inc., ticker CVE.
That's right, and we've been handed the comprehensive Q3 and 9 months ended September 30, 2025 financial and operational reports.
Yeah, this is the full package. We're talking the detailed management's discussion and analysis, the MD&A, and the supplemental info package. It's a truly dense stack of papers.
And our mission here is, well, it's laser focused. These documents are designed to communicate compliance, but our goal is to really extract the strategic narrative.
Okay, so what are we looking for exactly?
We need to isolate the critical insights on Cenovus's operational execution. Where did they find leverage this quarter? Their true immediate financial strength, and, maybe most importantly, how their recent strategic moves validate their entire business model.
So we're going beyond just the big revenue numbers.
Exactly. We need to understand the tangible levers that drive their long-term valuation and their competitive position in what is, arguably the most dynamic global energy market we've seen in years.
Okay, let's unpack this then. I think we should start by first establishing exactly who Cenovus is, because that term, integrated energy company, gets thrown around a lot, but for them it means something very specific and very powerful.
That's an essential starting point. Cenovus is a massive Canadian-based company headquartered in Calgary, Alberta.
And when we say integrated, what does that actually mean in practice?
It means they control the full cycle. From the heavy work of pulling hydrocarbons out of the ground, that's the upstream, all the way to refining and marketing those products directly to consumers, which is the downstream.
And the scope of their upstream operation is just immense. They're fundamentally built on those vast Canadian oil sands projects up in northern Alberta. That's their core, right? The heavy bitumen production engine.
That's the core, but it extends way beyond that. Their upstream portfolio is actually highly diversified. It includes thermal and conventional oil, natural gas, NGLs, all across Western Canada.
And you have to add in the offshore piece, too.
For that geographic and product diversity, you absolutely have to include their crucial offshore component. We're talking significant crude oil production offshore Newfoundland and Labrador, and then there's smaller but still strategically important gas and NGLs production offshore China and Indonesia.
Okay, so that's the production side. Then you have the downstream, which is all the infrastructure needed to process that heavy, complex crude they produce.
Right, and this includes substantial upgrading and refining operations, both in Canada and in the U.S., which lets them convert that raw bitumen into high-value products, things like gasoline, diesel, jet fuel.
And this dual structure, this is what brings us to their core strategic advantage, isn't it? The power of integration.
Yes. They develop, produce, refine, transport, and market the whole chain. And this is critical because it insulates them from major external pressures.
Let's spend a moment here because we need to really explain how this works, not just say that it works. How does owning both sides actually mitigate the volatility, especially around crude price differentials?
That's a fantastic question because the mechanism is where the financial genius of the structure really lies. Let's imagine two scenarios. Scenario one, global crude prices are high, but the spread between WTI, that's the light sweet benchmark, and WCS Western Canadian Select, their heavy crude, that spread widens dramatically.
Which happens when Canadian pipeline capacity gets tight.
Exactly. So in that scenario, the upstream side, the producers, they suffer because their heavy product is getting a huge discount compared to the global benchmark.
So the realized sales price takes a big hit.
A major hit. However, their downstream side, their own refineries, suddenly see massive margin expansion.
Why? Because the feedstock they're buying is now suddenly way cheaper.
Precisely. The feedstock they're buying, their own heavy crude, is now significantly cheaper because of that widened differential. They buy it cheap from themselves, effectively, and sell the finished products like gasoline and diesel at global market prices. They capture that entire difference as refining margin.
So if the WCS discount is, say, $25 a barrel, their upstream business is hurting, but their downstream business just saved $25 a barrel on its input cost. It's a literal internal financial hedge.
That is the mechanism. It means Cenovus is structurally designed to handle the historical problem of Canadian crude, which has always been takeaway capacity. Even if they can't get all their crude to the best markets, they have guaranteed internal demand at a favorable cost when those differentials blow out.
Which makes this next section so much more compelling, because the Q3 2025 results weren't just good, they were record-breaking. They delivered results that seemed to strongly validate that whole integrated strategy.
Absolutely. When you look at the investment thesis for Cenovus, Q3 2025 is the quarter that provides the hard evidence. It shows that all their optimization work is translating directly into peak output.
Let's start with the sheer magnitude of the operational records. Cenovus achieved a record quarterly upstream production of 832.9 thousand barrels of oil equivalent per day.
And that's not a small increase. That's a sequential jump of almost 10% from the 765.9 MBOE they did in Q2.
And the engine behind that was the oil sands segment, wasn't it?
It was. It set its own quarterly record of 642.8 thousand BOE per day. And this wasn't just, a simple bounce back from maintenance. This was the result of successful execution on their sustaining and optimization projects finally coming online.
What's so fascinating to me here is that the downstream side kept pace, which proves the integration is synchronized. They hit a record crude oil unit throughput of 710.7 thousand barrels per day.
Which represents a total crude unit utilization of 99%.
99%. I mean, you literally cannot get materially more oil through those pipes.
And that operational strength translates instantly to the bottom line, especially when you're running at 99% utilization. Their adjusted funds flow, or AFF, leapt to $2.5 billion in Q3.
That's a massive sequential jump from the $1.5 billion in Q2.
A huge jump.
Okay, wait, let's go back to AFF for a moment. Why do management and analysts focus so much on adjusted funds flow instead of just, standard net earnings?
That's a crucial distinction. AFF is a non-GAAP measure, so it's not strictly governed by accounting standards, but it's invaluable for showing the real financial health of an energy major.
Okay.
It's essentially cash flow from operating activities before changes in non-cash working capital. And why that matters is it strips out non-cash items that can heavily skew net earnings, like deferred tax liabilities or, and this is critical for a company like Cenovus, the unrealized foreign exchange gains or losses on their massive U.S. dollar denominated debt.
So AFS gives you a cleaner picture of the actual cash generated by their operations in the quarter. It separates it from all that paper accounting volatility.
Exactly. And the drivers for that $2.5 billion in AFF were, 1, superior operational performance, those production records, 2, higher sales volumes, and 3, a huge, stunning boost from the stronger margins delivered by their U.S. refining segment, a segment that had been, frankly, struggling.
Beyond the operations, the quarter was really defined by Cenovus tightening its strategic focus. They executed 2 major transactions that I think tell you everything you need to know about their capital allocation philosophy.
The first one was the WRB divestiture. On September 30, they sold their entire 50% interest in WRB Refining LP, which was jointly owned with Phillips 66.
And that brought in a lot of cash.
It did.
Mm-hmm.
The sale generated US $1.3 billion, which is about, $1.8 billion in proceeds.
And this wasn't just selling an asset for cash, it was a philosophical statement, wasn't it? Management was very clear this aligns with their strategy of owning and operating core assets. I see this as them shedding a non-operated joint venture liability.
That's absolutely the right way to look at it. In a non-operated JV, you get the economic benefit, sure, but you don't control the operational decisions, the capital spend, the turnaround schedules.
You're just along for the ride.
Right. By shedding WRB, Cenovus simplifies its asset base and it concentrates all its capital and management focus on its 100% owned facilities where it has total operational control. This maximizes the strategic benefits of their heavy crude integration.
And then, immediately after that divestiture, they demonstrated the concept of capital recycling. They went out and initiated a strategic acquisition, Meg Energy Corp.
A highly complementary move. The first step was acquiring 25.0 million Meg common shares for $752 million, and this was just after Q3. But the real goal here is the expanded operational scale. The Meg assets are expected to add about 110.0 thousand barrels per day of high-quality thermal production.
And crucially, this production expands their existing Christina Lake asset base. So this isn't just growth for growth's sake. It's synergistic growth that leverages their existing infrastructure and expertise.
It's a textbook case of strategic alignment. They sold a non-core, non-operated asset for $1.8 billion to immediately invest $752 million into a highly efficient, core-adjacent production platform.
Which leaves over $1 billion for other things.
Right. The remaining proceeds can go directly to debt reduction or shareholder returns, which fulfills their stated capital policy.
And speaking of returns, Their commitment to capital allocation and shareholder returns is, well, it's still aggressive. They returned a staggering $1.3 billion to common shareholders in Q3 alone.
That return was primarily weighted toward buybacks. They spent $918 million on share repurchases through their NCIB program, and that's alongside the base dividend of $356 million.
And that aggressive buyback schedule, that signals management's confidence that their own shares are undervalued relative to the cash generation power of the business.
It does.
This is where it gets really interesting, I think, digging into the actual execution on the upstream side. Let's start with the oil sands, which is just the sheer scale and economic backbone of this company.
The record 642.8 MBOE production in Q3 is the headline, but the real story is in the execution. This record volume came directly from optimization activities and the ramp-up of sustaining well pads across 4 key areas: Foster Creek, Lloydminster Thermal, Sunrise, and the ongoing ramp-up at Narrows Lake.
So it feels like this is the culmination of several years of pretty substantial capital investment finally hitting the production numbers.
Precisely. And let's look at the 2 major capital projects that are nearing completion, which indicates this large investment cycle is winding down. First, you have the Narrows Lake tieback to Christina Lake. That's complete, and new volumes are contributing just as planned.
And the second one is Foster Creek.
Right. And perhaps more importantly, the massive Foster Creek optimization project is now approximately 98% complete as of the end of Q3.
98% complete is, for all intents and purposes, done. What tangible assets did they actually bring online during the quarter to support that record?
They brought 4 new steam generators online ahead of schedule. That is a massive achievement from an engineering and project management perspective.
Absolutely.
And those generators support immediate production increases, and the associated new well pads are expected to come online in early 2026. So the benefit from this optimization work is actually still compounding.
And at Sunrise, they're actively preparing a new well pad for steaming in Q4. So this shows that the sustaining and optimization capital is continuous. It's always feeding that growth funnel, even as the really big projects rack up.
But we also have to address the minor operational hiccups, because these do impact the cost structure. It wasn't a completely perfect quarter.
Right, the shut-in at Rush Lake.
We saw the temporary shut-in at the Rush Lake facilities, part of the Lloydminster thermal assets, due to a casing failure at a steam injection well back in Q2.
And when did management say that would be resolved?
Management expects to safely start the ramp-up of production at Rush Lake by the end of 2025. This incident, combined with planned maintenance, had a clean impact on costs for the 9-month period.
So their per-unit operating expenses for oil sands went up.
They did year over year, and the MD&A directly links this to the higher costs from the Rush Lake incident and the major turnaround costs at Foster Creek and Sunrise during the first 9 months of the year.
Okay, let's pivot to pricing dynamics, because this is so critical for the oil sands business. We have to talk about the Western Canadian Select, or WCS, differential, and also the cost of condensate.
Analyzing the WCS differential is vital for understanding their realized prices. The WCS price at Hardisty relative to the WTI benchmark, it narrowed significantly in the first 9 months of 2025 compared to 2024.
And for a heavy oil producer, a narrower differential means a higher realized sales price. That's a huge positive for them.
It's a massive tailwind.
So why did that gap shrink so dramatically? This feels like the biggest structural change in the Canadian energy landscape in a long time.
It's driven by 3 interconnected factors. First, and this is the most fundamental one, the startup of the Trans Mountain Pipeline Expansion Project, or TMX. TMX provides massive new dedicated market access for Canadian heavy crude to the U.S. West Coast and, crucially, to Asian markets. This reduces the risk of Western Canadian crude getting bottlenecked.
So it addresses that long-standing structural problem that Cenovus's integrated model was designed to hedge against in the first place. Now they have external market relief on top of their internal refining capacity.
Exactly. Secondly, we've seen sustained low inventory levels within the Western Canadian Sedimentary Basin itself. And third, global demand for heavy crudes is unusually strong right now.
Why is that?
It's largely due to declining production from other major heavy crude suppliers like Mexico and Venezuela, coupled with strong global demand for fuel oil, which is a product heavy grades yield more of. It's a supply-side constraint meeting new market access.
That makes the outlook for WCS strong, but we have to look at the corresponding expense. Condensate. This is the ultimate example of just how complex producing bitumen is.
It is. Condensate, or diluent, is required simply to make the thick, molasses-like bitumen fluid enough to pump through pipelines. The blending ratio is high, typically between 20 to 35% diluent per barrel.
So the profitability of the oil sands segment is dictated not just by the WCS price, but by the price of that condensate relative to WCS.
That's right. And what we saw in Q3 was the condensate WCS differential actually decreased in the first 9 months of 2025.
And a decrease in that differential means the condensate cost relative to the price of their product was higher.
Correct. It reflects a tight Canadian supply of diluent and low inventories, which partially offset some of the positive gains Cenovus saw from the narrowing WCS-WTI spread.
Let's put a dollar figure on that expense just to grasp the scale. The source material shows that Cenovus incurred $6.5 billion in blending expenses just for the 9 months, ended September 30, 2025.
$6.5 billion. I mean, that is purely the cost of buying the fluid required to move their primary product. That figure just underscores why the relative price of condensate is almost as important as the selling price of the heavy crude itself.
Any structural relief on diluent pricing or any tech innovation that reduces that blending ratio would translate into billions of dollars of savings for them.
Annually, yes.
Okay, moving from the oil sands backbone, let's look at the offshore segment, specifically the West White Rose project. This is their single most critical near-term growth project outside of the acquired MEG assets.
This project, offshore Newfoundland, is Cenovus's future growth engine. It represents a significant capital outlay since they restarted it in 2022, about $2.2 billion invested so far. And the key takeaway from Q3 is that this project is reaching the finish line. It's sitting at approximately 98% complete as of September 30.
That's a massive de-risking achievement. What were the tangible milestones they hit during the quarter?
The engineering feats were pretty remarkable. They completed placing the massive topsides, the operating deck atop the concrete gravity structure. They also completed the subsea tie-ins to the existing infrastructure, the CRO's FPSO system.
So the big structural components are integrated.
They are.
What's the timeline for first oil? Because the market is definitely pricing that new volume in.
The critical path now is the hookup and commissioning of the platform systems, which is expected to wrap up in Q4 2025. Drilling is slated to start by the end of 2025, and the project is firmly on schedule to deliver first oil in the second quarter of 2026.
Hitting that Q2 2026 timeline is essential for their medium-term guidance.
Absolutely.
And outside of that major project, we also saw Atlantic production increase in the 9-month period.
That was due to the ramp-up of the existing White Rose field after they completed the CRO's Asset Life Extension, or ALE, project earlier in Q1.
So that shows the immediate payoff of sustaining capital. You extend the life of a major asset, you immediately restore lost volume.
Exactly. Conversely, their Asia-Pacific production saw a slight decrease in the 9-month period, mainly because of lower contracted sales volumes in China, though this was buffered a bit by higher buyer nominations in Indonesia.
Okay, let's wrap up the upstream with the conventional segment. It may be smaller, but it delivered a massive margin swing. The operating margin jumped to $41 million in Q3 2025. From just $12 million in Q3 2024.
The segment benefited from stronger performance from new and base development wells, which increased production. But the margin expansion was primarily driven by lower operating expenses, specifically reduced turnaround costs and decreased processing and gathering costs compared to last year.
But hold on, the real strategic insight here comes from their gas sales. They deliberately increased their sales volumes to U.S. destinations to capitalize on better pricing. In Q3 2025, 34% of their natural gas sales went to the U.S. market, up from 29% in Q3 2024.
This is critical execution in a segmented gas market. The Canadian benchmark AECO was suffering. I mean, it was languishing at an average price of only $0.63 per McF in Q3. Meanwhile, the U.S. benchmark NYMEX was substantially higher, averaging US $3.77 per McF. By increasing their ability to divert gas south, they instantly multiplied the value of those sales, providing a huge immediate lift to the segment's realized pricing and margin.
So Upstream is executing flawlessly, managing costs, delivering major projects on schedule, and strategically optimizing their sales to capture the best market prices. Now let's jump over the wall and see how their integrated refining arm, the Downstream, processed all that record volume of heavy crude. This segment delivered a truly stunning financial turnaround.
The Downstream segment's strategic role is to be that natural partial hedge against heavy oil differentials. In Q3 2025, the U.S. refining segment didn't just hedge, it swung dramatically from a deep loss to a major profit, providing definitive proof of the integrated model's resilience.
Massive is the right word. Look at the U.S. refining operating margin. It went from a staggering loss of $383 million in Q3 2024 to a gain of $253 million in Q3 2025.
That is a $636 million positive swing in one quarter, year over year. That's not a rounding error, that is a structural change.
That's a phenomenal turnaround. What drove it?
It was driven by four key factors that we should probably dissect. First, the market environment was favorable. The Chicago 3-2-1 crack spread, that's a proxy for refining profitability, it increased 30% year over year.
Okay, so a better market.
Second, utilization increased dramatically to 99% in Q3, up from 89% a year ago. And this was due to operational improvement initiatives and, critically, the completion of major turnarounds, specifically at the Lima refinery in late 2024 and the Toledo refinery in Q2 2025.
So they were running at peak capacity into a strong market.
Right.
But efficiency wasn't just about throughput, it was about cost control too.
Correct. Per unit operating expenses, if you exclude the turnaround costs, decreased significantly to $9.67 per barrel in Q3, down from $12.74 per barrel in Q3 2024. This reflects lower repairs and maintenance spending and the payoff from their ongoing business improvement initiatives.
But the source material flags a specific and arguably non-repeatable driver that was key to the scale of that swing.
The receipt of small refinery exemption. SRE waivers.
Oh.
Okay, we have to stop and explain what those are and why they matter so much.
This is critical for you to understand. The U.S. Renewable Fuel Standard, or RFS, requires refiners to blend renewable fuels into their products. If they can't, they have to purchase these expensive credits called Renewable Identification Numbers, or RNs, to comply. This is a massive compliance cost.
So RNs are basically environmental compliance tickets, and if you don't use them, you face penalties.
Yes, a small refinery exemption, or SRE waiver, is a reprieve granted by the EPA that exempts a small refinery from this costly obligation for a period.
So this was a huge cost they didn't have to pay.
Right. For a quarter like Q3, where operational costs were low and crack spreads were high, getting these SRE waivers meant Cenovus did not have to absorb billions of dollars in RN compliance costs for the exempted facilities. Okay, wait, if they received waivers, how did the market price of RNs still impact them? The report notes that the average cost of RNs still increased by 63% in Q3 2025 compared to Q3 2024.
That's the beautiful nuance that shows why the waiver was so timely. The 63% cost increase demonstrates that the market pressure to buy these compliance credits was intensifying dramatically. If Cenovus had been subject to those full costs, that $253 million profit would have been drastically smaller, or maybe even a loss, despite the strong crack spreads.
So the SRE waivers served as a massive financial shield.
Exactly. It allowed the positive market dynamics, like the high crack spreads, to flow almost unimpeded into their realized refining margin.
That makes perfect sense. The waivers let them capture the market uplift without bearing the escalating compliance cost.
Now, switching gears to the Canadian side, the Canadian refining assets had a more stable story, but one of efficiency nonetheless.
They continue to run near or above full capacity, ensuring high throughput and production volumes. But their big win was really on the cost reduction side compared to the previous year.
The cost reduction was substantial because 2024 was an anomaly. Operating expenses decreased so much because the prior year included the largest turnaround in the history of their upgrader.
So the comparison was easy.
Right. For the 9 months ended September 30, 2025, per unit operating expenses, excluding turnaround costs, plummeted from $16.67 per barrel in 2024 to $10.93 per barrel. That $5.74 decrease per barrel shows that the underlying Canadian cost structure is highly competitive when it's not absorbing massive maintenance costs.
Before we move to the balance sheet, I noticed foreign exchange impacting nearly every reported number. The Canadian dollar generally weakened relative to the U.S. dollar in the first 9 months of 2025. What does a weaker Canadian dollar mean for Cenovus's financial reporting?
This is one of those complex accounting points we need to slow down on. Since Cenovus sells nearly all its products, crude oil, NGLs, natural gas, refined products based on U.S. dollar benchmark prices like WTI or NYMEX, a weaker Canadian dollar is a tailwind for revenue.
Okay, so when they translate those U.S. dollar sales back into their reporting currency, Canadian dollars, the reported revenue figure is higher.
Correct.
So the revenue looks great, but hold on, doesn't that also mean they just saw paper losses on the debt side? They carry a huge amount of U.S. dollar denominated debt.
You've hit on the counterpoint exactly. A significant portion of their long-term debt, about US $3.7 billion, is denominated in US dollars. When the Canadian dollar weakens, that fixed US dollar liability appears larger when translated back to Canadian dollars on the balance sheet. This creates unrealized foreign exchange losses when they calculate net earnings.
So the FX environment gave them a boost in reported revenue, which helps cash flow in AFF, but at the same time it created a accounting headwind in net earnings because of the increased reported size of their US dollar debt.
Precisely. It complicates the net earnings figure, which is why, again, AFF is a better measure of operational performance. They are managing currency risk, but the accounting translation volatility is just inevitable given the nature of their business and their debt structure.
So we've established that operationally, the upstream is hitting records, and the downstream had this massive, well-timed turnaround. Let's turn to financial management and capital discipline, which dictate how Cenovus is funding its future and returning capital.
Financial management remains very disciplined, which is foundational to their credit rating. Total debt decreased by $551 million since the end of 2024. That's primarily due to the scheduled repayment of unsecured notes, including some that matured in July 2025. It shows they're meeting their obligations.
And yet net debt, which is total debt minus cash, it actually increased slightly to $5.255 billion compared to $4.614 billion at the end of last year. For a company so focused on debt reduction, that seems a little counterintuitive. How do we square that circle?
This is entirely a matter of timing, which the critique noted we needed to clarify. The increase was due to heavy intentional spending in the first 9 months. We're talking $3.5 billion in capital investment, $1.3 billion in share repurchases, and $1 billion in base dividends. That all exceeded the cash they brought in from operations.
And the crucial timing component.
The $1.8 billion in proceeds from the WRB divestiture. It was earned and accounted for in Q3, but the cash was only received by Cenovus on October 1st, 2025, the day after the quarter closed. So that $1.8 billion wasn't in their capped balance on September 30th to reduce the net debt figure.
So if you factor in the actual cash receipt from WRB, their net debt position immediately improved by $1.8 billion early in Q4. That's a strong financial position, especially given they financed $3.5 billion in capital spending first.
Exactly. And their core leverage ratios confirm this strength. Their net debt to adjusted EBITDA ratio is at a very comfortable 0.6x, and net debt to adjusted funds flow is 0.7x.
And both of those are well below their long-term target of 1.0x.
Right, a target they aim to maintain even if WTI prices drop all the way down to $45 per barrel. This is the definition of a robust investment-grade balance sheet.
And their liquidity confirms this. They had nothing drawn on their substantial $5.5 billion committed credit facility as of September 30th. That is a massive operational cushion.
Let's quickly detail where that spending went. Total capital investment for the 9 months was $3.547 billion, and this is heavily weighted toward upstream. $2.1 billion for oil sands and $728 million for offshore, which is funding those major projects we talked about, like West White Rose and Foster Creek.
And their full-year guidance confirms this. They're expecting to spend between $4.6 to $5.0 billion total for the year. This is split about $3.2 billion for sustaining capital, just keeping the base running, and between $1.4 and $1.8 billion for optimization and growth. The key takeaway is that the growth capital is focused and finite. It's concentrated on closing out these two major projects.
Which leads us back to their core capital allocation framework. This is the ultimate goal for the shareholder. Cenovus has a very clear target. Once net debt is near $4.0 billion, they plan to return 100% of excess free funds flow, EFF, to shareholders.
How close were they to that $4.0 billion target in Q3?
Including the WRB cash receipt, they are now substantially closer than that reported $5.255 billion figure suggests. They are rapidly approaching that threshold.
And even before they hit that, they're still returning a lot of cash.
They are. While they returned $1.3 billion in Q3, their actual EFF for the quarter was $745 million. This indicates that management is retaining the flexibility to accelerate returns through discretionary things like the buyback program when market conditions are favorable, even before they officially hit that 100% EFF return policy.
This shows a really clear path forward. Maintain the balance sheet strengths, complete the major projects, and then shift that capital entirely to shareholder returns.
Now, looking forward, the outlook section of the MD&A confirms that, external volatility is not going away. The global crude oil trajectory remains highly dependent on two major factors. First, the pacing of the unwinding of the OPEC plus voluntary production cuts, and second, continued geopolitical tensions globally.
The document mentions the ongoing conflicts between Israel and Iran, the Russian invasion of Ukraine, even tensions involving supply routes. These factors just prevent the market from finding a stable supply-demand balance and continue to fuel price volatility.
But critically, for Cenovus specifically, they expect that positive narrowing of the WTI-WCS differential to continue, which is tied directly to the TMEX expansion. This suggests continued strong realized pricing for their heavy oil sands output.
Assuming new Canadian supply doesn't completely overwhelm that new export capacity in the near term.
That's the caveat. On the downstream side, they correctly anticipate continued volatility in refined product prices and market crack spreads, which will be heavily influenced by seasonal demand shifts and global refinery utilization rates.
And finally, natural gas.
Right. AECO and NYMEX prices are expected to remain range-bound, though there is a compelling long-term catalyst. The prospect of new LNG facilities in the U.S. and potentially Canada ramping up over the next year could significantly increase demand for North American gas, which would provide structural support for prices, especially NYMEX.
Okay, so to synthesize the Cenovus story, in Q3 2025, they are delivering record operational performance across both upstream production and downstream throughput. They are executing major multi-year capital projects like West White Rose and Foster Creek efficiently and on schedule.
And this execution is all backed by a robust financial framework, which enables aggressive shareholder returns via those massive buybacks. The core takeaway for you, the learner, remains the resilience offered by their integrated model. Q3 was a definitive proof point, showing that by controlling the full value chain, they can maximize margin capture, especially in the downstream segment when those market dynamics shifted.
It really seems like Cenovus is entering a highly anticipated transition phase. Large-scale capital investments are winding down, operational efficiency has peaked at 99% utilization, and the strategic direction shedding non-core WRB, acquiring those highly synergistic MEG assets, is purely focused on enhancing core quality and scale ahead of hitting that final debt target.
And that strategic focus sets up the ultimate question for investors moving into 2026. Cenovus is rapidly approaching the moment where the capital expenditure throttle is eased way back.
So what does this all mean for the future?
Given that the significant capital investment pipeline is closing out with West White Rose and Foster Creek nearly done, and the $4.0 billion net debt target is rapidly nearing, how might the successful and swift integration of the 110.0 thousand barrels per day of new production from the MEG assets impact the pace and magnitude of future excess free funds flow allocation towards shareholder returns?
So you're saying the combination of lower spending and new cash flow could really accelerate things?
It could. The combination of reduced capital spending and a substantial acquired cash flow stream could potentially accelerate that shift to the 100% EFF return policy far sooner and with greater force than current consensus estimates. I mean, Cenovus is positioning itself for a cash generation fire hose moment.
That's certainly something to mull over. The next 12 to 24 months look extremely interesting for Cenovus shareholders. Thanks for watching and subscribe if you found this podcast helpful.